So it's in this section, funding. So first, why do we have this? Since most of our audience here are not accountants, so I would be explaining the liability aspect. So for our capital structure, we have companies, right? And there we have the basic accounting equation. We have assets equals liability plus capital. So all the assets that a company has, the funding of those assets depends, either it came from liabilities or it came from the capital or the equity section. The capital or the equity section is from the shareholders, so that is their contribution. Sometimes it's in the form of ordinary shares or the other capital in the equity. And for the liabilities, these are funds from third parties. So under the liability section, we have two kinds. We have current liabilities and non-current liabilities. So the current liabilities, this is the debts that we have that is related in the normal operations of the business. For example, our payments to the suppliers, for supplies or the services that we had. So most of those kinds of current liabilities, they are found here in business. We have discussed this in the earlier sessions under business and purchases. So when we have those transactions, it is reported under accounts payable. So when we check the reports here, it is in this section, accounts payable aging or the account payable detail. So for those liabilities, for those liabilities, we have them here in accounts payable. Those are the liabilities in the normal operations of the business. While for the funding module, which is a composition of the capital structure, it can be long-term liabilities. We have it here in the funding management. So why did we separate it? So why is it that in our system we created a separate module for that? The first reason is the scope of the functionality of this liability. So for the accounts payable module, it typically focuses on this short-term liabilities, while on the other hand, here in the liability or the funding management module, it encompasses a broader range of the liabilities that we have. And this includes the loans, finance leases, and right-of-use obligations. And then most of these liabilities are more complex, so they have amortization tables. So it composes of the principal and the interest, and also they have regulatory compliances. So when it comes to regulation, it is more strict in the standards for these liabilities. That's why we have created a separate module for this. So we start with this. So when we go to funding, it's divided into four. So we have the loans, finance list, right of use, and loan payable. So for loans, we have the classifications here. So when we create a loan, these are the classifications that we have. We have bank loans, which is common. We have bridging loans. Bridging loans sometimes are loans that are related to asset acquisition. So for example, a company is planning to sell a building in the near future and to purchase another. And before and there's a gap and timing difference between this purchase and sale, and they would usually get a bridging loan for them to acquire the asset before they get the proceeds from the sale of the other building. And then bank overdrafts, these are negative balances of cash, and they are considered as current liabilities. And then other loans, commercial papers, and notes or secured bonds. That's for loans. And then we have finance lease. So for the finance lease, these are leases that are long term, and sometimes it ends up in sale of the leased property. And then we have right of use. Right of use, this is rental. This is rental, but due to changes in standards, they created this right of use where there is an asset that is related to your liability for your rents. So when you record this right of use liabilities, it also creates right of use asset under the assets management. So we have this, like you see here in our list, we have right of use liabilities here. And then when we go to the assets, here in intangible assets, we have here the right of use assets. So this is linked in the liabilities that we have here. And then for the loan payable, how is it different from the loans? The loans, this is usually from the banks or financial institutions. While from the loan payable, this is from usually from employees or those that are related to the company. So we have here loans due to ultimate holding company. We have loans to intermediate holding company, loans to subsidiaries, associates, joint ventures, directors, employees, and other related parties, and also non-related parties. So under liability management, it's classified as this. And then when we have the multi-currency liabilities, example for this one, we have liabilities denominated in US dollars. And it's also reflected in the functional currency of the company. So like this, we have also the functional currency for that date. And then for the filters, you can use the lender here. So if you just want to see a certain lender, the loans that we have from them, or also the date. So when we click the date here, the balance of those liabilities as of that date is reflected here. Even for the non-functional currencies like the USD, if we click another date, these computations are based on the closing translation rates as of that date. So we also have this. They can also download the file here. That's working right now. May I ask from the other team, from Natasha and Ali, have you tried the download file section of this liability management yet? Natasha? Ali?
Yes, yes,
Is it working
yes,
on your
sir.
end? Okay, maybe we get back to that later. I think they're fixing something from assets management, property, plant, and equipment, according to David a while back. I called him before our training. So that's for loans, and then we have finance leases here, and then right of use, and then loans payable. So the next one, we're going to do it in the system. So we're going to create the loans, and then we'll explain the steps, the reasons for those steps. Why are we doing it that way? So when we create a loan, first we have here the contacts, and then liabilities. It's a bank loan last year until, so this is 2 years. The $4. And then we have here the interest rates. Say at 10%. So when you're keying in interest rates, if you leave this blank, for example, if there's no variable rate and you leave it blank, it's gonna show an error. So there must be a figure here. And then the payments. The payment date. From date, when we place the from date here, it's not the start of the payment, it's the start of the loan. So in this case, the loan started January 1st. The amount would be 6,000 per month for 24 months. Repayment day would be the last day of the month, then submit. Then allocation of funds. So here in this section, loan release date, we have different fund allocations. First is bank deposits. So once we click this bank deposits and assign it here, and we finish with the transaction, it's gonna reflect in the bank that we have chosen. So we choose which bank. And then we place the amount. This would be the amount of the principal, which does not include the interest. And then second, we can also use it to repay other loans. So so we have this feature wherein we can assign a loan to pay another loan, and that would actually make it easier for the users to manage their debts. So why is this option here? First, it's for refinancing opportunities. So in business, sometimes when the users want to take advantage of better terms, or for example, for lower interest rates or different repayment schedules offered by new loans. So for instance, there's a company that has loaned 100,000 SGD for this year, and then their interest rate is 12%. And then there's another entity or financial institution that has offered the company the same loan at the amount of 100,000, but the interest rate would be at 10%, so it's lower. So sometimes the companies would like to take advantage of this opportunity. So they would assign the proceeds of that 10% loan to pay the existing loan that they have, so that they would cut the finance cost that they have. So in our system, we allow the users to use this to repay the loan, so that they wouldn't have to go again to separately record the repayment of the loan in the first loan, and then they have to record again the second loan. So once we click here that it's going to be assigned to another loan, it would automatically reflect in the loan balance. It would automatically be deducted from the loan balance of the first loan that they would assign the loan to. So that's one of the reasons. And then the second reason why there is a repayment of loan here is consolidation of debt. So sometimes when the users or the company, they have multiple loans, and they may find it advantageous to consolidate their debt into a single loan for favorable terms or for easier management of their debts. And then the third reason would be for restructuring purposes. So in some situations, the users may need to restructure their debt obligations to better align with their cash flows or the needs or the payables of the entities or the financial goals that they have. So sometimes this is in relation to asset financing, or if they want to finance um, a building, putting up a building, or PPE construction. So they can use these loans for funding, and they can they can manage it easier, and the recording and the monitoring through our system would also be easier. So in this case, let's just say they chose bank deposit. So um this account 1045978. So let's look at the balance. So it is this account. Let's see, this is the one. 20,000. They can also add here the secured assets. So if there's an asset that they use for security for the loan, they can add it here. So this secured assets, they use it sometimes have to have opportunities for bigger amounts of loan, because some loans, I mean, some financial institutions would require security for loans for bigger amounts. So they can add them here, but it's not mandatory. So they can add it later on. So we click this, save as final. So it's already created. So when you look at the liability here, the loan overview, you see the loans and the interest. So as of this date, so once we choose a date, for example, the date that we have is January 31st, which is the first end of the month. So we see here the loan and the interest reconciled. We have listed the interest rate a while back. So this is the loan and then the interest. We haven't recorded any payment yet. So when we record the payment here, the payment is from this bank. First payment would be January 31st. Amount is 6,000. If there are penalties, then you can add them here. Also bank charges. You can also upload source documents here, like transaction documents, and then submit. Okay. So what's helpful to users in the system when it comes to non-accountants is that when they record the payments, like what we did a while back, we recorded the payment that is inclusive of the principal and the interest, the penalty, and the bank charges. They just have to put the whole payment in there, and this is the system that would automatically compute which is a part of the principal. So this is the loan. Our payment was 6,000, so the loan payment is here, and then the interest is automatically computed here. So the system determines which is a part of the principal and the interest. So when it comes to the posting in the general ledger and the reports, there would already be a correct posting, and that would be easier for them. So all of the computations are automatic here. So when we change the date, hold on. So Let's check the payment. So earlier we have paid the amount of 6,012. So we see here the payment and the penalties is reflected in the payment section, but for bank charges, it is in the reports. It's included in the reports for financial position, and it's not a part of the the liability schedules that we have. So when we click another date, for example, the next end of a month, which is February, so we haven't made the payment yet. So when you see the schedule here, we have the loan amount from the start of the loan, and then the interest amount that is accrued in that month. And then we have the payment on the credit side. It's deducted from this amount. So the outstanding balance of the loan is 115. And then accrual of the interest again by February 28th. So the amount of the loan is 115,958.33. So when we record the payment here, as we did earlier, of 6,000 to the second payment. You have to refresh the page since it didn't allocate the payments yet between which one is a part of the principal and the interest. The interest rate, we recorded earlier this fixed interest rate, fixed and variable interest rate from January 1st, 2023. This is editable. There should be a timeline for the editing of this interest rate, but I haven't got an update yet. Do you have an update, Natasha, as to the timeline on when they can change the interest rates as of the starting date?
I think the interest rate can be changed anytime.
No,
The
I
one which
think for the
is
change, the one that interest rate, you should add it on the, for example, you can change it subsequently, like say in April, after 3 months, the
the fixed
company,
doesn't get changed, but the one that
no,
is
no, no.
underneath, yeah.
No, the fixed rate means that's for the there's a fixed rate which is from
Yes.
for the whole amount of the principal. Variable
Yeah.
rate means the reduced amount of the loan. So
Yeah.
both of them can be changed, the fixed rate and the fixed rate and the variable rate. For example, if we have another rate, say on April 2023, after 3 months, the bank or the financial institution has reduced the rate to say 9% per annum, and you submit this. So as of this date, on April 1st of 2023, the computation on the loan amount would be changed already based on 9% and not 12%. But for this case, the question I had before was that this amount at January 1st, 2023, like users shouldn't be able to edit this interest rate. For example, they had wrong recording. They should just be given a timeline on which they can correct the wrong recording. So When it
am
comes
not
to the editing,
sure
when it
about
comes to
this.
the editing of the
Yeah.
first interest rate, which is the interest rate from the start of the loan, there should be a timeline. Like for example, if you have already paid the first payment January 31st, and then February you come and edit this from the start of January 31st, there would already be a mistake in the computations if that would be the case. So that's for interest rate. Then next would be secured assets. So for this loan, we don't have secured asset yet. So we can add them here. So why does the system allow us to do this? Sometimes for loans, for example, the financial institution has given a loan to this certain company, and then they found out that there's a problem with the company's financing or the company's funds. So what they would do is that they would ask the company for assets as security to be attached to the loan. So when we record this, for example, the loan that we had started in January 1st of 2023, and then the security, they ask for it in June or say July after 6 months until December. Oh no, sorry. 2023 security date would be until December of the same year. So I think we have our data found. I think for the user experience here also, Natasha, what should appear here would only be the assets that are in the list already. So once they click, they shouldn't be able to choose
I have given this input
choose
earlier, but I don't
assets
think
here
it
that
works.
don't have.
Yeah, I think it's not only here, but other areas as well, where like, it's a purchase, but they are showing you sales item as well. So I was like, it shouldn't be there. So they haven't gotten there yet. I will
Mhm.
give this input. Yeah.
Okay, so for secured asset, you can choose here. So in this case, it's unrealistic because the amount of the asset is just 300, but for example purposes, so we have here the plant and equipment. The asset category is office machine and equipment. This is the asset name, and then the asset series, this would be chosen from the assets that we already have. So these are the existing assets, maybe one that has a bigger. Okay, let's just use that. So this is tied up to the amount of the assets or the net of depreciation of those assets at that date. And then we just submit it. And then it's already here. We also have the action buttons here. We can delete. And then when we want to add, we add it here again, another secured asset. And reconciliation, like what we have also for bank reconciliation, we also have reconciliation here. So for example, at the end of the period, the bank has given a statement and we record reconciliation, the statement balance as of say December of last year. Oh no, that's this um, March 31st. This is the system balance, and the statement balance is just 50. And then we upload the supporting documents, submit. So the reconciliation would be reflected here. So it will bring the balance of the loan to what is in the statement balance from the bank or the financial institution from which they had the loan. So you see this computation, this shows the computation for the interest and the loans. And then we also have termination. So once we can terminate this loan. Go back to funding. It won't be here anymore. Okay, that's for the termination of loans. It's basically the same. I mean, essentially it's the same also for the recording of the what we have discussed for loans step by step. It's the same for the recording also of finance list, except for other details that are just related or applicable to that kind of loan. So in this case, I'll just show you the difference from each of the loan creation. Meeting management. So when we compare these two, it's just the same. Basically, we have here for loans, we have loans. For finance list, we have finance list, the interest rate, the repayments, the allocation of the funds, and the security. And then the computation of the interest rate that we have for the accountants here, I'm pretty sure that you already know this. We use the effective interest rate method. So to make it simple for funding payment, this is very simple. When it comes to the users, they just have to record the interest loan, I mean the interest amount, the principal loan amount, record the right date from which they are making the repayments. And then for the payments, they just have to enter the date of the payment and then how much would it be if there are penalties, if there are charges. When it comes to the computations, everything is already automatically computed in this system. Thank you, everyone. Also, thank you for the our developers from the Philippines. Thank you for joining our session today. I think that's it. Have a good week, guys. Thank you.